Hey, what's going on, everyone? Welcome back to the Real Workshop. Let's go! Well, AJ, thanks for joining us today on our podcast. We're truly excited to have you here to share all the secrets on how to get every single loan you've ever wanted, right? So we know you're extremely busy today with all-time lows and interest rates, as well as just people trying to take advantage of closing before the end of the year. So we really appreciate you joining. We're just going to have a really fun conversation today. We've got a lot of questions. We want to help our audience get better insights into how they can prepare to get loans on new acquisitions that they're looking at. Maybe look at how to strategically position themselves for refinancings, and just get a feel for the general market right now as it is. So we're really excited to have you, and we look forward to this conversation. And with that, I will turn it over to Key Lee.
Hey, Dan, thanks for the intro. AJ, again, welcome, and thanks for being here.
Yeah, thanks for having me on, guys. I'm excited to hang out for an hour and talk about something that the three of us are very passionate about.
Oh, Key didn't tell you this is a 3-hour session?
Oh, man. No, definitely did not tell me that.
All right, AJ, let's just start with telling us a little bit about yourself. When and how did you get started in the business?
Yeah, so I grew up in Mansfield, Ohio, which is an hour north of Columbus, and came down to Columbus to go to Ohio State and was majoring in finance, kind of learning a little bit about finance, but just getting my feet wet, and started interning at MSF Real Estate Capital after my sophomore year, which is the company that I ended up working for full time after graduation. And they were a mortgage banking shop that did a lot of life insurance company debt origination, and started interning there for the summer. Had no idea what commercial real estate was. Every time I told my friends that I was interning in real estate, they thought I was out selling houses. And quite frankly, I didn't know that I was doing anything much different than that until I showed up the day that I showed up, and started learning about the world of commercial real estate, and never really looked back. I interned there after my sophomore year, after my junior year, and then during my senior year, and started working there full time in 2012. Was there for 10 years, and we just got acquired. Our firm, MSF Real Estate Capital, just got acquired by Walker Dunlop earlier this year in 2020. So I've really been with the same group ever since after my sophomore year in college, and never really looked back.
Awesome. So, we wanted to talk about like some of the differences between, getting a residential loan versus commercial loan, because there's it's a different ballgame, right? So for our audience to kind of understand like some of the differences, can we just start on a high level? So for a residential loan, right? When I buy a house, I just apply to just a bunch of different lenders. They check my credit score and they check my debt and income, DTI, right? And then I just go with the lowest rate, and there's the mortgage. So for commercial loan, right? How is it different, as far as the process, the things that the lenders are looking for? Are they still looking at my credit score and debt to income ratio, or what else are they looking at?
Yeah, for sure. So the main difference, I would say, or the high level difference that kind of separates commercial real estate versus residential real estate is, one is for your personal residence, somewhere that you're living, that's very straightforward and simple. And the other one is an investment, where there's a lot of different strategies, a lot of different structure, and usually a lot higher dollar amount as well, which triggers lenders to dig in a little bit deeper when that loan amount has an extra 0 or 2 or 3 zeros. So high level, that's kind of the big difference. As far as what lenders are looking at, they're looking at the property, they're looking at the market, and then they're looking at the sponsorship. And there's a lot of different things that they're looking at within those 3 areas, but those 3 areas kind of make up your general 3 pieces of the puzzle that need to fit together to make sense for a capital source or a capital provider to provide a loan.
Right. So rather than looking at the borrower's income, would you say a bigger consideration is given to the asset's financial performance and perhaps the experience of the borrower in the business?
100%. And it depends on if it's a recourse loan or a non-recourse loan. And that's a big difference between a commercial and residential loan as well. A residential loan is always recourse, and a commercial loan can be recourse or non-recourse. And if it's a non-recourse loan, those are typically loans with debt funds, Freddie Mac or Fannie Mae, or life insurance companies, and sometimes banks as well. But if it is non-recourse, they're really relying on, does the property itself underwrite? Because non-recourse by definition is, the lenders aren't able to come after the borrower or the sponsor's personal assets. And in the event that a sponsor hands over the keys to the lender, all they have is the property. And they need to make sure that that property is going to underwrite and that they're not, getting over levered or out in front of their skis on the property. The sponsor doesn't quite matter as much in some ways from an income perspective, but like you mentioned, does matter a lot from an experience perspective, because when you're doing a non-recourse loan, you need to make sure your sponsor, one, has the experience to be successful and pay the loan back, and two, is going to be able to weather the storm, whether that means that we end up in the middle of a national pandemic with coronavirus or something else. There needs to be cash on the balance sheet to make sure that they can weather storms and get through tough times.
Okay, I think we talked about several things there. You talked about the recourse versus non-recourse, and I think this becomes important when the investor is trying to get a loan guarantor, right? Let's say a group is syndicating a deal where they're getting a bunch of investors together. Somebody needs to sponsor the loan, and if the loan is recourse, it's a lot tougher pill to swallow because the sponsor is going to be personally liable for the loan. So I think the recourse versus non-recourse becomes critical when a group is trying to get a loan guarantor. Is that right?
That's right. Yeah. I mean, a recourse loan, if you don't qualify for the loan yourself, you might be going out and getting a guarantor. And that guarantor is going to want something in return for signing, his or her balance sheet on that loan. So definitely changes the game. If it's a very straightforward deal where you're not trying to push leverage super high and the deal underwrites well, you might be able to go out and get a non-recourse loan through Fannie, Freddie, or a life insurance company.
Right. And generally, in order to qualify for the loan, the person who signs for the loan has to have some net worth and liquidity requirements, right?
Yeah, that's right. So kind of a rule of thumb, and this moves around, and not all lenders have the exact same rule of thumb, but net worth equal to the loan amount that you're borrowing, and liquidity of 10% is kind of a good rule of thumb to go by.
Right. So if you're looking at like a $10 million loan, your net worth needs to be about that much, and you need to have liquidity of like $1 million. And if you don't have that, yeah.
I was just gonna say that's right. And as the loan amount increases and gets larger, those requirements get a little bit more flexible. When sponsors are doing $150 million loans on big properties, they don't necessarily need to meet that, one-to-one net worth and 10% liquidity. But when you're talking about loans that are under 10 million, that's a good rule of thumb to go by.
And just to be clear, does their investment real estate holdings, the equity value within those investments, count towards their net worth?
Counts towards net worth. That's correct. Yep. Okay. Now, sometimes I'll run into a deal where I'm working with a sponsor, and the liquidity to meet the 10% is held in operating accounts for their properties, and they want to try and count that towards their personal liquidity. Typically, lenders, especially banks, like to see that liquidity in their personal, checking or savings accounts, or in the stock market, anything liquid, but in their personal name, not necessarily associated with an operating account for a property.
That makes sense. Now, AJ, earlier you mentioned, Fannie, Freddie. So, let's talk about that. So that falls under agency loans, right? So
That's
can
correct.
You kind of explain to us what agency loan is and how is it different from, say, a loan from a local bank, maybe some of the pros and cons?
Mm-hmm. Yeah, for sure. So agencies include Freddie Mac, Fannie Mae, and then FHA HUD as well. And Walker Dunlop is a direct lender for those three capital sources. So this is something a little bit newer to me. doing that business direct. When I was MSF Real Estate Capital, I was not what's called a DUS lender. And now I am. So when I was doing loans with the agencies at MSF, I was doing them through another DUS lender, through a Walker Dunlop or someone similar that's a DUS lender. So now I'm doing that business direct with Freddie, Fannie, and HUD, which is great. And it's really expanded my platform. And quite frankly, it's really hard to compete with those three in the multifamily world. They don't lend outside of the multifamily world. They will lend on like mobile home parks or manufactured housing communities, but outside of that and multifamily, they're not providing loans for commercial or office or self-storage or anything like that. So when you're doing a multifamily deal, if it is stabilized, it's typically the agencies are typically the most aggressive. The agencies provide a few benefits over a bank. One, they're non-recourse loans. Banks are typically recourse loans. That's a big point. And we started talking about recourse versus non-recourse. And I think everyone can understand that a non-recourse loan is more attractive than a recourse loan. Another big difference is going to be rate. The agencies are super aggressive on rate. We've closed a couple deals sub 3% with the agencies this year on multifamily. Banks aren't as competitive in that world. Banks typically offer a 5-year term. They don't like locking up a rate for much longer than 5 years, where the agencies will do a 5, 7, 10, 12, or even longer term, fixed rate. Interest only. The agencies provide interest only, sometimes full term interest only if the leverage is in the right spot. So a little bit lower leverage, around 55 or 60%, you can get interest only for the entire term. But if it's not interest only, it's a 30-year amortization versus banks are oftentimes 25 years. So that's helpful on your cash flow. Those are probably the main differences between banks and the agencies.
Now, what are some of the downsides? How about like the loan requirements? And how about like some of the terms of the loans? Are there any downsides to agency loans?
It's a little bit harder to maybe get approved if you're beginning in the real estate world. The agencies are providing a non-recourse loan, and like we discussed earlier, they want to see experienced borrowers. So a bank, and especially like a community bank, might be a little bit more willing to go out on a limb with a borrower that's just starting out and doesn't really have the track record that the agencies might look for or might require. Costs to close can be an issue, or not an issue, but can be more expensive than a bank. There's a little bit more red tape and a little bit more due diligence done by the agencies. They're going to require a phase 1 report and a PCA, property condition assessment report. That's going to be costly. And then who knows what ends up being found in those reports and issues that you might have to work through to get to the closing table. So there's some things like that. But as far as economic terms, it's really hard to compete.
Right. So great terms as far as like rates and, locking up rate for a longer term, longer amortization, but a little bit harder to qualify. Would you say that sums it up?
Yeah, I think that's right.
Okay. Now,
there are other things. For instance, just something that popped up this year where the federal government came out and basically said you can't evict any tenants if you have a loan that's backed by the federal government. So if you had a Freddie or Fannie loan during COVID, you weren't able to evict tenants. So things like that, there might be some additional requirements or red tape for taking a loan from that's backed by the government.
Got it. Now, talking about agency loans, like, it's my understanding that when somebody buys a house and they take out a mortgage, a lot of times the loan is sold back to the federal government, right? To Fannie or Freddie. So the banks, they just get the loan off of their balance and then they go out and, they can lend again. Like, can you tell us how it's different for commercial lending? Like, do they do the same thing? And if not, how does that affect the borrower?
Yeah, so Freddie and Fannie, and this is the main difference between Freddie and Fannie, is Freddie securitize their loans and they're sold off to the secondary market, and Wells Fargo and banks and big financial institutions are buying pools of these loans, where Fannie loans are serviced by the DUS lender. So if you do a Fannie Mae loan with Walker Dunlop, Walker Dunlop is your servicer, and they're keeping that loan on their balance sheet. There's a little bit of a
Mm,
difference there. In regard to um, differences that a borrower sees, I really don't know that there is much of a difference. It might be a little easier to get to a quick answer if you're doing a Fannie loan because you're calling up someone that you have a personal relationship with that is part of the team that's servicing. But I'm not in the servicing world, so I can't really speak super intelligently to this. I don't think that there's a ton of difference that a borrower sees between
got it.
Freddie and Fannie.
Well, would you say like a local bank, right? That's doing a portfolio loan where the loan is going to be in their books. They're going to be a lot more interested in the deal than say a bank that's doing a mortgage for a primary residence, right?
Mm-hmm.
Because the bank that's doing primary residence, they're going to sell it off anyway, so they don't really care. It just checks the boxes and it's good to go. But a bank that's going to have the loan in their books, they're going to be a lot more interested. Hey, who's the sponsor? What's this deal? And they might be more interested in the details of the deal.
Yeah, 100%. On the commercial side, which I don't know much about the residential side other than I've gone out and gotten a couple residential loans for myself. Outside of that, and I've used, bankers or brokers to help me do that. But on the commercial side, I would say that that's accurate. Although the secondary market so Freddie's the only one that's really bundling these up and selling these off. The CMBS market is as well, commercial mortgage-backed securities, which is something that was a little bit lenders that were a little bit more active a year or so ago during COVID. That's kind of dried up a little bit, but they were doing the same thing, bundling up mortgages and selling them off to the secondary market. They kind of have the process down so well that they're doing all their due diligence, crossing their T's and dotting their I's, because they know in order for the loan to get sold off, everything needs to be super clean.
Right, that makes sense. Now, I think we were talking about this a little bit, but could you tell us a little bit about some of the typical terms you might find in a commercial loan? You talked a little bit about the amortization. How about like, you talked about like 5-year term versus 10-year term. Can you talk about like how the interest rate or amortization might be different from say a residential loan that's 30 years fixed rate, and maybe talk about balloon payment and address what that is?
Yeah, for sure. So do you want me to kind of keep this on topic of multifamily versus residential, or do you want to talk globally about commercial loans where we include office and retail and industrial? Because there's differences in the different asset types, I guess.
Yeah, let's talk about I guess residential versus like a multifamily like apartment.
Okay, perfect. So multifamily commercial loans on the multifamily side of things, I guess. Your rate is going to be based off of the 10-year treasury typically, because typically you're borrowing on a 10-year loan.
Right.
So it's a spread over the 10-year treasury, which has gotten a little bit funky over the last 9 months with COVID and the 10-year being below 1% and dropping, to an all-time low ever. So all lenders were kind of putting floors in place on the 10-year treasury. And we saw those floors be around 70 basis points and then around 90 basis points. But what those lenders are doing is they're providing a spread over the 10-year treasury. So life companies, for instance, they have pools of money that they're investing in all different types of investment vehicles. And what they like to do is they like to compare their 10-year fixed rate commercial loans to what they can get on a AAA rated bond. And they want some sort of spread over that bond for the risk that they're taking on for providing debt on a commercial real estate asset, as it's a riskier investment than a bond. So that's kind of how the rates are looked at on the commercial side, whereas residential side it's a 30-year fix. Pretty much everyone's doing a 30-year fix, and the residential rates are a little bit more straightforward and streamlined, and there's not much difference between lenders. But a life insurance company might be underallocated on multifamily right now and get a little bit more aggressive on their spread to win a deal.
Right.
So that's a little bit of information on rates. Amortization on multifamily is typically 30 years in the permanent market. HUD will go 35 years. They'll also go 40 years on a construction loan. They'll do a 40-year fixed rate deal with a 40-year amortization. So I guess 30 to 40, but most of your permanent business is done at a 30-year am. What else do you want me to hit on?
Well, what about balloon payment? This is not common in like a residential loan, right? But in commercial loan, there's a balloon payment at the end of the term. So can you tell us what that is?
Yeah, so typically, let's just say you're doing a 10-year fixed rate deal and you're amortizing it over 30 years. So you're making payments on this loan as if it was a 30-year loan, but at the
Right,
end of your 10-year period, the lender wants paid off. So the
right,
lender's giving you a rate based on a 10-year fixed rate, and there's going to be a balance. So if you're borrowing a $10 million loan on a 30-year am, in year 10 you might still owe $7.5 or $8 million. At that time, you have to go out and either refinance the deal with a new loan or sell the property to pay off your lender.
right. So those are, some of the bigger differences than like a traditional, say, residential loan. Okay,
Excuse me.
that's good to know.
Yeah, a residential loan's fixed for 30 years. And at the end of your 30-year period, there's not going to be a balance. It's going to be paid off. So
Right,
one thing
right.
that the permanent lenders on the commercial side do is they put prepayment structure in place, which is something that's different than a residential loan as well. A residential loan, if you decide to sell your house in 2 years, you just pay off whatever your balance is.
Right.
Well, if you got a commercial loan that's fixed for 10 years, there's going to be prepayment because these lenders are giving you a rate and assuming that their money is going to be out for 10 years. And they're looking at their return on that money over a 10-year period. So if you pay the loan off, you have typically what's called yield maintenance. And yield maintenance is basically making the loan whole with rates at that time. So let's say you're 3 years into a 10-year loan. It's year 3 and you want to sell the property on your $10 million deal and you still have a balance of $9 million. What that lender is going to do is they're going to take the 7-year treasury rate because there's 7 years left on the loan term. And they're going to apply that 7 years to the $9 million and calculate what you owe them as a prepayment penalty or prepayment premium to pay off the loan.
So,
and it can be very expensive, like very
wow.
expensive.
So you're paying off the loan in 3 years, but you're going to pay all the interest that you would have on 10 years. Is that a simple way to look at it?
That's a simple way to look at it. That's not the exact math, but because they're using rates at that time, and if rates go up or down, it can hurt or help you. But yeah, I mean, that's essentially what they're doing. They're making sure that they get whole. They're taking that $9 million and saying, I have to reinvest this $9 million over the next 7 years. What can I make? And I want to make the same amount of money.
Got it. I'm glad they don't have yield maintenance on single family houses. That would be pretty rough.
Yeah, that's right. People would be moving a lot less, that's for sure.
Yeah. So prepayment penalty, I mean, it's similar idea, but it's not as, I guess, severe as yield maintenance, right?
Yeah, so you can structure prepay a lot of different ways with lenders. And really what they're going to do is they're going to adjust their rate up or down, depending on if they feel like they're, giving in or taking a little bit more. So if you were to you can do a step down prepay where it might be 5% of the loan balance in year 1, 4%, 3%, 2%. And it may go out 10 years. It may go out 5 years. It may just go out 3 years. It just depends. But you're going to pay for that in one way or the other. You're going to pay for it in the rate maybe a little bit to get that flexible prepay.
Got it.
That's something that's different than that makes commercial loans a little bit more complex and different than residential loans is the strategy of your investor kind of guides what you might do on a prepay structure, which is going to guide where your rate ends up, and it's going to guide what kind of term you take. If you know that you might pay off the lender and sell in 3 years, it doesn't make sense to do a 10-year loan. You should be doing a 3 or a 5-year loan. And there's a lot of different flexibility and a lot of different products out there and ways to structure a deal to make sure that it makes sense for the investor.
Right. And I think in our previous conversation, you mentioned something about a floater, right? and that's a way to mitigate some of the yield maintenance. Can you elaborate on that a little bit?
Yeah, so the whole purpose of yield maintenance, as I just went through, is to kind of match up, they're putting money out for 10 years fixed at today's rate. And who knows where rates are going to go over the next 10 years. So the yield maintenance kind of protects them. Well, if your lender isn't locking in your rate, really it's Freddie and Fannie that'll do these floaters and debt funds as well. But you can float your rate, and it's going to change every month based on where LIBOR moves, and LIBOR is going away and being replaced by SOFR. So where SOFR goes over the term of the loan, and you're going to pay a spread over SOFR. So Fannie or Freddie or whoever the lender is knows that they can borrow their money on 30-day increments at LIBOR, which is I don't know what LIBOR is today, 15 basis points or something like that, and they're going to charge you a spread of 250 or 300 over LIBOR. And as LIBOR moves, you're gonna either share in that savings or pay for the increase in the rate. But if they aren't locking in a rate for 10 years, there's no need for a prepayment penalty.
Got it.
So it can remove that prepayment penalty for the lender or for the borrower. Sorry.
So I think it'll be important for an investor to be aware of things like this, where when they're getting a great rate for an agency loan, but it has yield maintenance. If they were able to get a floater, now that gives them more options and the ability to exit earlier than planned.
100%. If it's a short term, and even if it's a long term, we're starting to see a lot of our clients take the floating rate option, just because appreciation's been strong in multifamily, and you might think that you were going to hold something for 10 or 12 years. And you get to year 3 and it's worth a significant amount more, and somebody throws an offer your way and you want to get out. But the risk that you're taking with that is if rates increase, we're in historic low rates right now. And if rates increase in 3 years, your cash flow is getting hit because your rate's changing. So it really depends on what your philosophy is and what your game plan is with that property.
Now, does the floater cost anything? Like, what would be a downside? Is there a reason why a borrower might not do a floating rate?
You might have some additional fees on the front end. You're still probably going to have some sort of exit fee to get out of the loan. But the real risk is that you get 2 or 3 years out and your 3% rate that was floating is now 5%. Where you could have locked in, at 3.25 for 10 years.
Right.
That's the real risk.
Got it.
If it's a long-term hold, and you know that you're holding this property, it probably makes sense in today's environment to lock it up for as long as possible. Rates are extremely low right now.
Right. That makes sense. So it really depends on the investor's strategy as far as structuring the loan. And it seems like you can customize a lot of different facets of the loan.
100%. The first thing I do when a new deal comes in from a sponsor is figure out what their game plan is. And game plans change, but let's talk about it and how dead set are you on that game plan. And now let's go out to the market and let's structure this deal in a way that achieves the goals that you're trying to achieve. And there's lots of different levers on a commercial loan that you can pull. Leverage, interest only, floating rate versus fixed rate. There's lots of differences. We have some life insurance companies that in lieu of doing yield maintenance, you pay 1% of the loan amount at closing on the front end. And then it's open for prepay. It may make sense to do that. It may make sense to, write, if we've been using a $10 million loan, it may make sense to write the $100,000 check to have the flexibility at closing.
Right. Now, let's shift gears a little bit. Can you tell us what debt service coverage ratio is and why the lenders are interested in this number?
Yeah, so the debt service coverage ratio is a metric that the lenders look at to see how tight or how risky a deal is. So the lenders are going to underwrite the deal. And in the case of multifamily, you have your rental revenue with your other income that you're collecting for pet fees and things like that to get to a gross income number. And then you have your expenses. You have your real estate taxes, your insurance, your repairs and maintenance, your payroll, your management fees, all of that. You subtract that from your revenue to get to your NOI. The DSCR, the debt service coverage ratio, is your NOI divided by your debt service. Lenders like to see a 120, 125 bare minimum, which means that you can cover your debt service payment. And debt service is your monthly loan payment or annual loan payment, depending on how you're looking at it. Which all those factors, amortization, interest rate, loan amount, all come, that's how you get to your debt service. And they want to see how well you cover your debt. And the higher that metric, the higher that number is, the better. If you're at 2.0, that means that your NOI is 200,000 and your debt service is 100,000, and you can cover your debt service 2 times. That would be, a very conservative, low risk loan for a lender to look at. If it's at
Do you guys
1,
have
yeah, go ahead.
Is there a different DSCR target for a interest only loan versus an amortized loan?
Yeah, so they're going to look at, even if it is interest, that's a good question. Even if it is interest only, they're going to look at it as if it's amortizing, especially because all of these lenders are looking at their exit, right? Let's say they're doing a 5-year loan. In year 5, are you able to refinance the balance? And let's say rates go up 200 basis points. Are you able to refinance your balance and still cover your debt? So the lenders are going to look at all the sensitivity, and the exit is a super important thing that lenders are looking at that a lot of borrowers don't think about. They're looking at it today, and they're saying, hey, hang on a second, I'm covering, this is an interest only loan and I'm covering at 150. Like, why is there any issue here? Well, interest only might not be available at the end of your loan term in year 5. Let's say if you did a 5-year loan, and it might be a 25-year amortization, and rates might have increased by 200 basis points. Do you still cover your debt? Because if you don't, how are you going to get a loan out in the marketplace to pay me off, the lender? So, they're looking at that debt coverage ratio now, and then they're running sensitivity on it, reducing rents, increasing expenses, increasing interest rates, and making sure that you can still cover your debt.
That makes sense. So you said typical debt service coverage ratio that banks are looking for is like 1.2, 1.25, which essentially means that the net operating income is 1.25 times whatever the mortgage payment is.
That's correct.
Got it.
The
so
higher
it's just,
that coverage is, the better.
Yeah. So you're just trying to see how well the property performs financially, that it's able to pay the mortgage payments comfortably.
That's right.
Got it.
Yep, 100%.
Now,
that's a huge thing, especially on a non-recourse loan.
Yeah.
Again, because a lot of times on these commercial loans, the sponsor has investors in the deal, and it's the property that's paying the debt. It's not your personal income like on your residential house, where I can see how much money you're making and understand that you're able to cover your debt.
Right.
Property needs to cover the debt.
Now, initially, when getting a loan, how much does the buyer need to put down? I know it varies, but what's like a typical loan to value? And can you contrast between loan to value versus loan to cost?
Yeah, for sure. So let's just take a straightforward stabilized multifamily deal to start. That $10 million purchase price. The max loan in what's considered strong markets by lenders would be 80% of purchase price. So getting an $8 million loan on your $10 million asset or $10 million purchase price. That's going to be your maxing out on leverage. All of your other metrics are going to need to work. Your DSCR is going to need to work. They're not going to go to 80% if it doesn't cover debt, right? So it needs to underwrite with strong sponsorship in a strong market. 75% is way more common, way more straightforward. That's kind of down the middle. But oftentimes what we're seeing in the Columbus market, at least, is people are buying this property for $10 million, and they think if they put $2 million of CapEx and capital improvements into the property, it's worth $15 million. So now we have a $12 million loan or $12 million cost, and we might be able to get 80 or 85% of the total cost as long as it hits 75% of stabilized value. So oftentimes I'll be working on a value add multifamily deal, and we'll go out and we'll try to get 80, maybe even 85% of the total cost budget, as long as we can prove to the bank that once you're done with the work, your leverage level is still only 70 or 75% of stabilized value. So that's kind of how the cost versus value works together.
So loan to value is just the purchase price. It's percentage of the purchase price. So 75% loan to value is you're gonna need to put down 25%. The loan's gonna be 75% of the purchase price. Pretty simple. But loan to cost is when there's construction involved.
That's right. Yeah, and sometimes it's not on a purchase, right? Sometimes you've owned the asset for 5 or 10 years and you want to refinance. And then your value is going to be what the appraiser and what the lender ends up underwriting to on a value from a value perspective. When it's a purchase, value's easy. The market tells you what the value is. When it's a refinance, it's subjective. What cap rate do you use on this property? There's not an open market telling you what the value is. So it can be value or purchase price for loan to value. Loan to cost is very specific. It's your purchase price plus your costs, or just your purchase price, because that is the cost to buy the asset.
Got it. All right. Now for commercial loan, right? Can you kind of walk us through like the due diligence process? Like what kind of inspections are typically done? And obviously this is going to vary from lenders, but what would you say is like more typical of what the lenders want to see as far as inspections?
Yeah, so the lenders are typically relying on me as the local mortgage banker or mortgage broker working on the deal. So if I'm working on a new deal, I'm going to go drive the site and see a couple units. I'm then going to underwrite the deal. I'm going to pull rent comps. I'm going to pull sales comps to support the value that I'm underwriting to. I'm going to underwrite the historical profit and loss statements to see how the property has performed over the past 2 to 3 years, and then specifically how it's performed over the last 3, 6, and 12 months, and try and look for trends. And I'm going to underwrite to what I think pro forma NOI is. At that point, I'm going to send it out to the lending market. All the lenders are going to underwrite it, and they're going to beat it up. They're going to run sensitivity on it. They're going to push back on rents and say, hey, this is where we're comfortable getting to NOI, and this is what loan we're comfortable getting to. So that's a whole process, supporting the NOI that I'm trying to underwrite to, and getting the lender and everyone on the same page, looking at the deal the same way from a value and from a performance perspective. Once at that point, a lender typically provides a term sheet. And if it's a term sheet that we want to move forward with, we get the deal into committee. And when we get the deal committed, that's when the third parties start happening. And by third parties, I mean an appraisal report to validate the value that we underwrote to and support it. A phase 1 to check soils and make sure that it's a clean site. A PCA to check out the building and tell us about roofs and foundations and things that need improved at the property. An ALTA survey to show the legal description of what you're buying. Then you get title involved as well to make sure we have clean title and there aren't a bunch of liens on the property from the past. And we're working towards getting to a closing and making sure that the lender is very comfortable with the asset that they're financing. We're also underwriting the sponsors during that time, and making sure that you guys have clean background checks and checking out your experience and your credit report and all of that, and digging into how much liquidity you have, and underwriting your tax returns to make sure that you guys are going to be able to pay your debt service. Makes sense.
So PCA, would you say that's like an inspection report?
That's exactly right. It's an in-depth, much more detailed inspection report.
Got it.
For a commercial asset.
Well, we covered a lot of things, just different terms and different options with commercial loans, how it's different from residential loan, underwriting process. Now, AJ, if I were to ask you, because you probably worked with a lot of, different borrowers, different lenders, can you think of a few things that mm, that you might find like a little bit annoying from a borrower? Like, what are some, I guess, mistakes or some of the things that borrowers do that could be annoying for the lender or for a loan broker?
Yeah, I mean, the more organized you are, the more willing the more willing you are to provide the documents that I need to put my package together. Sometimes it's a hassle to, excuse me, it's a hassle for borrowers to get together all their K-1s for the last 3 years, and they might delay getting you that information, and then they wonder why you haven't gotten the deal into committee yet. And
Mm,
everything that I'm requesting and asking for is to get as clean of a package put together as possible, and put that in front of the different capital sources to get as clean of an answer as possible, as quickly as possible. So organization and providing documents is huge. Um, you know, there's scenarios where someone hears that I did a loan at 2.91%, because I mentioned that I did one under 3%, right? And
yeah,
then they wonder why their loan isn't 2.9%. And
right.
not all deals are the same. There's different risk associated with every deal depending on location and sponsor strength and all of that. It's not just, and I think that might come from the residential world, right? When you're buying a house, it doesn't necessarily matter if you're on high in Maine or if you're in a Class C location, right? Residential rates are kind of residential rates, and I think people get that confused with commercial, where
Hmm.
the government isn't necessarily buying all of those loans. It's staying on the balance sheet, and there's risk associated with it, and
Right.
different risk equates to different interest rates. So oftentimes they'll hear that their friend went out and got a 3% loan on their asset that's in downtown LA,
Yeah.
and he borrowed 50% leverage, and wonder why his property in Columbus, Ohio, at 80% leverage isn't getting the 3% rate. Um,
Right.
so just managing expectations and having realistic expectations, I guess, would make my life a little simpler.
Got it. Got it. That makes sense. So I think you covered, you know, the next question I was going to ask, which was, what can borrower do to set themselves up for success, right? Be more organized and have more, I guess, aligned expectations of loan terms and rates. Anything else you
Yeah.
can think of?
What can borrowers do to set themselves up for more success? You know,
Maybe do a
keep
better job underwriting.
Yeah, realistic underwriting, right? Sometimes borrowers will lease a couple of their units at $900 rents, and the rest of them are at 825,
Mhm.
and want me to underwrite everything to 900. It's like,
Yeah.
well, I can do that, but I can do that 24 months out.
Yeah.
It's different than underwriting it today. So realistic underwriting is definitely helpful, but real estate investors are real estate investors for a reason, and they take risk, and they're typically very optimistic, and they're going to push. And I need to be pushed to make sure that you're getting the best loan that you possibly can. One thing that has been very helpful for me is I'm a borrower as well. I own a couple apartment complexes in Columbus, and being on the other side of the aisle has kind of allowed me to put myself literally in the shoes of my clients and understand where they're coming from, and understand that eighth of a basis point, or eighth of a basis point on the rate is important to my cash flow, and that extra year of interest only is important to my cash flow. And I have investors in my deals, and I need to pay them the returns that I'm trying to pay them. And I understand it from the side of the borrower who's pushing me to underwrite everything to 900 and use a 2 cap in Columbus, Ohio.
So AJ,
Right.
on that point, how do you guys, or let's start with, what platforms do you guys typically use to look at the comparable rents? And secondarily, what are some of the best ways that you've seen investors push you to see the opportunistic upside on the rents?
Yeah, so we with Walker Dunlop, this is something that has been another positive of joining the Walker platform. I have access to Yardi, Yardi Matrix. I have access to CoStar. I have access to Reese. Um, Walker has their own platform where I can go in and look at all the different agency loans that have been done in my market and pull expense comps and rent comps. And then our group in Columbus is closing somewhere between 70 and 90 deals a year. And on every one of those deals, we're doing appraisals. And on every one of those appraisals, there's rent comps in there and rent surveys. And I'm able to kind of pull that information and use that information to help guide where rents are and support my rents. What really gets hard to support is when I'm doing a construction loan on a new development and we're looking 2 years out to rents. And the developer says, hey, rents today in this location is $1,000, but rents are growing at 3 or 5% in Columbus, Ohio, year over year. So I want to trend my rents out, 2 years. And then I got to get the lenders to buy into that. And that's not the easiest thing to do, but there's support to do it. And you got to pull the reports and get a lender that buys into the location and buys into the property.
And how much in detail are they going into to study that area? Because I'd imagine you're looking at lenders, they're looking at a national portfolio of opportunities. How will they know one block, east is maybe Class C and one block west is actually Class B or Class A? And they get a model that shows the rent of the Class A area for the Class C, area, right? And it's really only 2 blocks away in some cases.
100%. So, part of my role is making sure that I'm covering the market accurately and in the right way. And if I'm selling to a lender Class A rents on a Class C property, that lender's going to figure that out at some point, right? Exactly. And I'm never able to do a loan with that lender again, anyways.
Yeah.
So they're relying on me as the local correspondent and knowing the market. I would say that's probably the short answer.
Yeah, no, that makes sense. Let me ask you more on a, market sort of guidance. Many people look at the deals that are happening continually out on the trades, and you see these larger investment companies executing on these deals where you sort of think about it and you're like, wow, that strategy, if it works, it'll be great, but it seems like a risky maneuver because they're paying a high price for a certain property. What are some things that maybe the top of the, the cream of the crop companies have access to, or that they're structuring creatively that maybe the common, traditional investor is not really looking at?
Yeah, cheaper equity is probably where it starts. They have such a proven track record that the equity behind them isn't looking for the 18 to 22% IRRs. They're okay taking the 10 to 12% IRRs because it's a less risk investment in their minds, because they've proven that they can execute over and over and over again and give those returns to their investors. So the cheaper your equity gets, the more aggressive you can get on your acquisition price and on your debt.
Because for them, it's just they're taking the management costs or management fees, for the asset.
Exactly right. Yeah, it's a little bit different investment philosophy. And with cheaper equity, you can get more aggressive on the acquisition. They're also likely preferred borrowers by Freddie and Fannie, and they're probably getting a little bit better debt terms because of that, because they've proven that they can pay back loans and be good borrowers and execute. So that helps as well.
When
better
you look
your
at
debt, more aggressive you can get.
Yeah, no, that makes a lot of sense, and that's a really good point. When we talk about debt rates and we look at like historically when we were at historic lows, I think within the last decade, right, or close to about a decade ago as well, was there a growing concern that people were buying, appreciated assets because of the compressed cap rates? And we're sort of in that similar environment right now where cap rates are getting compressed, interest rates are extremely low, but this isn't going to last forever. But are you guys getting a little concerned right now in terms of the asset pricing?
Yeah, so one thing, and specifically to Columbus, that we've seen over the past 3 to 5 years is capital coming in from other markets, capital coming in from the East and the West Coast, because you're able to buy a multifamily asset at a Class A nice asset at a 5.5 or a 6 cap, where in the markets that are local to those investors, you can't find hardly anything that makes any sense at a 5.5 or a 6 cap. So we see institutional money, or I'm sorry, not institutional and East Coast and West Coast money coming into the market, and it's driving cap rates down. So that's something specific to Columbus that we've seen happen. In regard to as interest rates move down, cap rates move down with it, and as interest rates move up, cap rates move up with those rates. So that's just naturally what's going to happen. As your debt gets better, your acquisition prices are going to go up because you can meet those returns to your equity, to your investors.
Yeah, we're sort of in the new normal right now. We're kind of having to get used to some maybe less attractive numbers. Let me ask you this, as talking about a new normal. Airbnb is going public this week, and they're going to have a massive valuation, which means that they'll probably start expanding the business even more. As that business becomes normalized across, various, across the country, and more investors are flocking towards an Airbnb or short-term strategy, are lenders starting to open up more to underwrite to the revenues that could be produced from these, let's say, alternative revenue methods?
Yeah, so we were starting to make some progress on that pre-COVID. That was something that was coming up more and more often. The life insurance companies, the life insurance companies always kind of lag behind in regard to starting to underwrite new types of income, right? So we were starting to see progress with Fannie and Freddie on underwriting Airbnb income, and then COVID hit, and at least in our market, Airbnb revenues got destroyed and kind of went away. So I think we were taking steps forward in moving that direction, and I think we took some big steps back recently over the last 9 months now. So it'll be interesting to see. I don't know the answer to that. I know that Fannie and Freddie were talking about figuring out ways to underwrite it, and they have a bunch of requirements around it right now. And quite frankly, I don't even know that they're underwriting Airbnb units, because a lot of these apartment complexes had maybe a chunk of units within them that were Airbnb. I don't even know that those rents are getting underwritten today. Hopefully we get back to a normal world and we start underwriting that type of income. But today, no, that's tough income to underwrite.
Yeah. All right, AJ, as a final thought, let's look into your crystal ball as we enter a new presidency here and a new year. Where do you kind of see rates, going up, going down, stabilize? What's your thoughts?
Yeah, so without getting too much on my soapbox and getting too deep into my unique brain, I'll start with saying, one, if I had the crystal ball and I could predict that, I wouldn't be sitting here doing this. I'd be on a beach somewhere hanging out, capitalizing on that. Look, I think that our economy has gotten used to printing money and stimulus, and I think that we're going to continue to implement those strategies with the new administration that's coming in, and being as far in debt as we are as a country. I don't know how rates can move up and continue making our debt service payments. So I foresee rates staying low for the foreseeable future right now.
Yeah, that's a very valid point. All right. Well, hey, we are finally at the top of the hour. This was awesome. I mean, it seems like every time we talk to you, we get some more insights and get more information. So we really appreciate it. Thanks for joining us. And I'm sure we're going to ask you to come on again with further insights in the future. But for today, thank you so much. This was really an amazing session.
Thanks, AJ. Thank you, guys. Yeah, thank you.
Thanks for joining us today. You can find more episodes at therealworkshop.org.